Hello everyone, this is Avijit Chatterjee recording a Chartsarefun weekly YouTube session. This is for the week of March 10th. We're recording this on the March 16th, a Sunday. We had an extremely scary week last week. Market pullback 10.5%, starting with the peak around February 19th. That was a pretty fast and furious move down. As we know, the market adage that the market climbs an escalator and comes down really fast and furious on an elevator. That's pretty much what happened. We look at, for today's agenda, what Larry Williams, a legendary Wall Street technician and also Wall Street columnist, calling for a rally ahead. We'll show some of his reasoning. We'll look at the bearish sentiment, which is the American Association of Individual Investors. That has absolutely shot up in the percentage of bears that have been surveyed for the last couple of weeks. And the bulls have come down to extremes as well. So very little bulls at less than 20% and bears above 60%. So that's a contrarian sign. We look at market breadth indicator. We've talked about this in the past, in particular the New York Stock Exchange Summation Index. That to us is indicating a market reversal and a rally higher. We expect a higher high. We'll explain why, looking at the S&P's daily and weekly chart. And then finally, we do want to caution that when we do get this rally, this year, however, is setting up for a bearish kind of a correction coming ahead. So what we just saw was just a teaser. We expect the market to rally higher. We have the Fed coming out next week. We expect them to be accommodative. Good chance QT gets called off, the quantitative tightening that's been around for the last several months. Good chance that they may call that off. And we shouldn't forget that they have ammunition of cutting rates down. Right now, there was fears of inflation, tariff-related inflationary fears where they were cautioning on too many rate cuts this year. They had, I think, two cuts projected this year. That might change given the conditions of where the market moved significantly and so fast and furious. They could change that. So we'll see what happens with the FOMC at the press release with Chair Powell on Wednesday. And then emerging markets and Bitcoin and gold. We'll talk about all three. We feel emerging markets has been outperforming. So while the US pullback, emerging markets has been quite well this year. We expect it to set up to move from somewhere around the 43, 44 to the 50 level. So about a 15% rally expected in the emerging markets. And Bitcoin is signaling a higher high. We know that the high that we saw in around the December timeframe was 109,000. We expect Bitcoin to cross that 109 and head towards target near 135, 140. We'll explain why. One caution that many investors are piling on gold. We think gold is reaching a parabolic top. A measured target is near 31, 33. It's got over 3,000 last week. We think that rally is kind of, for the time being, getting a bit on long in the tooth. Would caution gold investors to start taking profits and kind of getting on the sidelines. Don't expect too much upside on gold in the near term or the next several months. So with that, this is our Chartsarefun Substack site. We publish blogs, and when the blogs get published, you get an email. So if you could subscribe to it, it's for free. You'll get the blogs emailed to you as soon as they get published. It's usually in the morning around 7 a.m. East Coast time. So these are in the archive section. You'll see our previous blogs. We talked about the emerging market patterns, and I'll touch on it briefly, looking at the MSCI Emerging Market ETF EEM. Our YouTube blog site is also Chartsarefun. We do believe charts are fun. We do believe there's a lot of interesting insights in charts. We are primarily an education service. We are not providing any investment advice. We are not registered investment advisors. Our goal is really to share fun patterns in charts that you can use towards your investment decisions. So that's what our goal is. We appreciate you subscribing to the channel. And if you like the videos, if you could hit the like button, we really, really appreciate that. So I talked about Larry Williams. He had a recording in the stockcharts.com. I'm a member of stockcharts.com. There are many other members. It's an awesome site, great for technical analysis. You can plot charts and so on. So for the members at stockcharts.com, Larry Williams recorded a session where he talked about why the market is ready to rally. That's what it's called. I'll share the link to the YouTube video on the recording when you look at the description section of the recording. But Couple of things he mentioned is he's got his own proprietary. By the way, Larry Williams is so well known. There are technical indicators. If you go to stockcharts.com, you'll see a Williams percent hour indicator, which is a market breadth indicator, a market stochastics indicator, and that's something that he is proprietary created. He's a very smart technician. He's got many indicators. Some of them are proprietary that not available in stock charts, but this William R, for example, is. But this particular indicator that he's sharing is his valuation model indicator, and he's showing that if you right now market is at an extremely screaming buy. Why? Valuation wise, it's hit at a very attractive point, similar to what it had done last in the August to September timeframe. You can see he's kind of circled in blue, and then before that was in the 2023 October low. So we are heading down to extremely attractive valuation models, which means from his perspective, this could be an attractive buying point. Further, he's talking about what has smart money been doing, and he has looked at smart money actually accumulating stocks while this 10.5% correction came. Look at the brown line climbing. This is the money flow. There are many money flow indicators. For example, Chaikin money flow indicator called CMF. I often follow the accumulation slash AD, accumulation slash distribution indicator. His is a proprietary one that he has, and he's been showing that money flow is indicating smart money buying into the rally, which is a great insight, telling us that smart money doesn't expect this to be the real sell-off that many in Wall Street want you to believe. Yes, bearish chatter has shot up. There is extreme bearishness. And in particular, if you look at the bear sentiment among the American Association of Individual Investors, there are about 2 million plus American Association of Individual Investor members. These are investors like you and me who manage our own 401k money, who would like to get professional advice. These are not necessarily smart money who are the members. These are regular investors who are their members. And you can see that that's hit 60.6, very close to the 60.9 that we saw in the 2022. Remember, we had a bear market, a cyclical bear market in 2022. So from the 2021 peak to October 2022, we shot down, S&P came down. And in that October low of S&P, we can see that that indicator had hit, that survey had shown 60.9% bears in that survey, which touched very close to that at 60.6 recently. This is a weekly survey, so we can see that since then it had fallen the next consecutive week and then went up a little back to the 59. Look at how stretched out the MACD is, extremely, extremely stretched out. So has the RSI, indicating that this is kind of hitting an extreme bearish sentiment. And if you look at that for the bulls is just the reverse, as you would expect. The bulls tends to be about 53 that we saw in the 2024 early time frame. Was even higher in the 2021, first part of 2021. It hit closer towards the 58 level, but where is it now? 19. We've not seen that in the last couple of years on 23, 24. The last we saw that 19 level was around early 23, and before that we hit even below the 19, around the 17 level, and maybe the 15 level at the first part of the bearish market breakdown in early 2022. So we are headed towards extreme bearishness and biggest drop of bulls from 53%, 52.7 down to 19.1. So that's, and by the way, if you look at an average over many, many years, the bulls tend to be on the higher side. On average, you see about 38% bulls. So from 38, you're getting half of it at 19. And the bulls and the bears and the neutrals tend to be about 30. And from 30, it's doubled to 60. So the bulls have halved from an average of 38 down to 19. And the bears have doubled from what tends to be about 30% up to 60, over 60. So that's the extreme of bull bear sentiment. Then I'm going to compare to an interesting insight I've shared, and moving forward, this is something I request everyone to follow. It's called the Summation Index. This is for the New York Stock Exchange. It's not just the NASDAQ tech heavy index, but this is the broader New York Stock Exchange with a variety of different stocks that are in that exchange. If you look at the summation index, which measures the cumulative advancers minus decliners, it fluctuates from 1100 on the plus side to minus 1100 on the downside. So we saw that the last time we saw that 1100 was around September, late September, October level in 2024. From there, it came on a steady decline towards the minus 435. It went up from there from the Trump win. Well, the Trump win was here in November. However, during that period, it kept falling to lower lows to the point where in mid-January, it went up to 266. That's when around the 19th of February is when S&P peaked and so did the summation index. It has dropped since then. However, the key indicator that you watch here is the moving average convergence divergence, MACD. Whenever the MACD histogram dips below zero, you get a volatility, a VIX climbed. So here we can see that the MACD dipped below zero, VIX climbed. This was even a more sharper VIX climb in the, remember the August 5th Japanese stock market crash, and then MACD fell below zero, VIX climbed. Key is when VIX climbs, it, however, comes back down, dissipates over the next couple of weeks. You can see that climbed, came back down, climbed, came back down, VIX climbed, came back down, VIX climbed back in December, came back down. We are setting up now for a VIX coming back down out of a climb. How did we predict this climb? It was this MACD again, shown in red, coming down below the center zero line. Whenever that MACD bearish crossover happens, look for a volatility climb. So in future, now we will likely have this MACD go back up above the zero line, fall a nice bell shape, and then when it sets for the next crossover, be prepared for a volatility. Notice just about when that happens is when VIX starts climbing. Just about when that happens, the VIX starts climbing. So that's an indicator. It's a magical indicator that I believe for bulls and bears to use for indication of when to start becoming cautious in the market. So that is where the blue elliptical regions have shown prior drops in the market and VIX climbs whenever the MACDs have dipped below. Now we are just the opposite. We expect the MACD to now base out, starts climbing back higher above the zero line, form a nice bell shape above the zero line. And while that happens, expect market to kind of have an upside. And during that period, like in the past, expect VIX to come back down. So notice VIX in this particular range has been anywhere in the upper 20s to the lower 12 to 13 levels. So I wouldn't be surprised in the next couple of months for VIX to come back towards the 15 to 13 level while the market starts climbing, while the MACD on this summation index starts climbing, which means I expect the summation index value from minus 272 to likely make another attempt, potentially depending on how bullish this outcome is from a Fed-induced rally and perhaps some form of a near-term deal on the tariff front. Wouldn't be surprised to see this summation index go back to the 1100 level. If you look at a longer term chart of that, we can see higher lows. If this has been an absolute breakdown in the US markets, as many have called, why hasn't the summation index broken to lower lows? It has not so far. Yes, it has declined for 3 consecutive weeks. Each candle here is a week of summation index range. It has come down, but has not taken out that low from early 2025. It's maintaining that pattern of higher lows. And every time it reaches the 1100, it pulls back. So I wouldn't be surprised for another touch of the 1100. And that would be potentially a time when you should lighten up on stocks and expect some form of an S&P deeper correction. So right now we can see even the MACD on the weekly is coming off a very oversold level from below minus 200 as we saw. And whenever it happens, for several weeks, it climbs to then kind of go up towards the plus 200 on MACD, and then it starts the next decline. So we can see that the MACD histogram in the weekly has stayed below the zero line for several weeks, right? For almost from early October till almost till, beginning part of February. So that's been for, 3-4 months of down of below zero. Now it is above. Yes, it looks like it might come back below the zero line, but I believe that this is going to take on similar to what happened here. That initially it climbed above, it was about to threaten to come down, and then it started climbing, maintaining for several weeks of upside above the zero line. I expect the MACD on the summation index on the weekly chart to remain above the zero line for the next couple of months while summation index reverses higher and makes a climb towards the 1100. That's the timing that I would use once it gets there to be cautious on the market and expecting for a downside move. This is the daily chart of S&P, the key indicator of accumulation, smart money accumulation, as Larry Williams called, is in this accumulation/distribution line. Look at whenever there is distribution, that AD starts declining. During this sell-off in December, we saw that the AD declined. But guess what happened from the January into the February 19th peak? Strong accumulation. Smart money was expecting upside in the markets. Yes, from there we got a very sharp shakeout, 10.5% from 61.47 to 55.04. That's 10.5% pullback in S&P in a very rapid, as we say, climbing up an escalator, down an elevator, a very sharp, quick drop. But in that, what is the AD showing us? The accumulation distribution flatlining. It's not showing us drastic drop. It's not showing us lower lows. It's maintaining higher highs to the point where it's now in the last week started climbing. You can see that the black line here has begun to climb from the previous week. I expect AD to start climbing again. This is also an upturn in the MACD histogram. Expect the MACD histogram to cross above the zero line and climb higher. Over the next 2 months, I expect next 8 to 10 weeks, the market to have some upside. Taking S&P, and I'll show you with now where I think the S&P target is. I expect it to take out this 57.94, which is going to be a key level. The 20-day moving average is around 57.94. Expect it to hit some resistance, take that out, go towards its 50-day moving average near 59.42, and eventually make a higher high. Why do I feel it's a higher high? That's from a beautiful pattern of Elliott wave theory. From that 34.91 2022 October low, we got a wave one climb from 34.91 to 46.07. So that's roughly 3,500 to 4,600 points. We got a drop from there, 46.07 to 41.03. So that's wave one, wave two. Then we got a wave three that just completed at 61.47. That's the wave three climb. So 41.03 to 61.47, you're talking about 243 points or 244 points. So that's the climb that we got, not 200, 41 to 61, 2,000. Roughly 2,044 points is what we got. So here we got 1,100. Here we got double that. So wave one, then the wave two pullback to 41.03. The wave three climb from 41.03 to 61.47 is 2,044 point climb. Then a drop. That was a sharp 10.5% drop that we got. Look at the tail that it left for this weekly candle. That's a bullish tail. A typical bullish reversal has a long tail on the bottom. Look at the volume. The last 3 weeks, volume has been extremely heavy. When does heavy volume come? This is capitulation. This is when you see active volume. This often is a money movement from retail investors to smart money. We know that the retail investors are bearish. That's where we saw the AAII sentiment. And where have they been doing? They've been selling to stronger hands. Smart money has been gobbling up those shares. So that's what smart money did, buying while the retail investors were panicking and selling. And that heavy volume often indicates a market bottom. Look at that part here in the, going into July to the August bottom, heavy volume right there. A bunch of red histograms showing the volume, red bars all at higher than in the past, indicating a bottom. Similar kind of heavy volume, indicating a bottom and a reversal higher. So if this is a wave one from 34.91 to 46, 1,100 points, a wave two decline from there from 46.07 to 41.03. That's about 500 point wave two. Then a wave three climb from 41.03 to 61.47, talking about 2,044 points. Then we got a 61.47 to a 55.04, talking about another 600 point drop. And now this wave five, often in some of the Elliott waves, the wave three is the longest. So this one you could expect to be a 2,000 point. Wave five in many cases matches the wave one. So this was about 1,100 points. Add 1,100 to 5,500, you're talking about 6,600. There's a potential we could climb up to a 6,600 top in the next couple of months. This could be a rapid climb, and from there I would be extremely cautious, and I'll explain why. This is looking at a longer-term monthly chart of S&P 500. What we do see is the longer-term chart shows a significant deviation of price from the climbing 50-month moving average shown here in blue. Here we can see from 4,800 towards somewhere around the 3,500, 1,300 point difference of price from the 50-month moving average. Where were we recently? We were on 4,600 on the 50-month moving average, and we hit 61.47. So you're talking about 4,600 to 61.47. That's over 1,500 points, 1,550 points. That's how much it had deviated from there. You get those resets every, it climbs up in a secular bull market that we're on that can continue till, it typically is a 20-year period, started at 2013 to 2033. You can see this secular bull market continue, but every few years, from a cyclical perspective, that price pulls back to test the 50-month moving average. So a pullback is expected this year. This rally that we get to higher highs would be actually a selling opportunity, and be cautious knowing that we could potentially pull back towards this climbing 50-month moving average test, just like we did in 2022. So that's what we should prepare for. But in the interim, like it's happened in the past, when you get such sharp drop, expect an upside move, and that upside move, especially knowing at the Elliott wave analysis I showed you, wave 1, wave 2, wave 3, wave 4, a wave 5 climb coming for about 1,000 to 1,100 points, taking us towards the 6,500, 6,600 level. That said, in this monthly chart, we can see MACD has begun to cross over in a bearish wave. Whenever the MACD histogram goes below the zero line and starts curving in the below the zero line, that's often where the pullback comes. We just about getting ready for the bearish cross. We've not quite gone there. I expect this to elongate a little bit, kind of staying there around the center line for a month or two, and then we will expect this bearish cross to happen. This bearish cross of the MACD would signal this drop to continue. So near term, a reversal, a higher high, just in time to then come back to lower lows below the 5,500 towards the 46. I expect the 46 to climb up towards the 4,800, which was the peak in late 21, early 22. That would now be very strong support. So I expect this 50-month moving average to climb towards the 48. That's where I think we would test in the next several months after the peak that we see in the next couple of months. So prediction is we head up towards the 66. From there, a pullback that could bring us down there. Key pattern here to look at from a macroeconomics perspective is whenever we've got in the past, in the historical time period, whenever we got steepening of the yield curve is the 10-year treasury minus the 2-year treasury. Whenever that has steepened, we've seen typically S&P pull back. And then you might have a climb, like, you can have a secular climb in here, but a pullback typically follows whenever steepening of the yield curve happens. You steepening of yield curve, a pullback in S&P 500. Steepening of the yield curve, a pullback in the S&P 500. This is during the COVID time. Steepening of the yield curve, a pullback in S&P 500. There's a slight lag. When the actual steepening started, it takes a few more months of rally, and then the sell-off happens. Same thing when the steepening started, a few months more of rally, a higher high, and then the drop. So in a similar way, we could get a higher high and then the drop. It seems inevitable. At the point where we are, we expect the yield curve to steepen, the 10-year to be going higher than the 2-year, and that steepening. Also, another factor to look at is on the macroeconomic factor. We know that there's been a huge loss of government jobs, perhaps the process of going from government to the private sector job sector, the process of rally, the tariffs that we are seeing across the environment. You might see some job loss. You might see technically a recession shape up. If a recession does shape up, as few are expecting, expect the unemployment to go higher. And that has also happened. Whenever we've had the steepening of the yield curve, unemployment has crept higher. Unemployment, this is on the top panel, the unemployment rate. We are right now around 4 to 4.1%. Expect that to kind of, may not go as steep as what we got. That was a COVID catastrophe. Don't expect it to go to 14% unemployment. Don't expect this 2007 financial crisis kind of unemployment of 8% either. But something around from going from near the 4 towards the 6 cannot be ruled out. So expect an unemployment to tick higher towards the 6%, recession shaping up, and the yield curve to steepen in the next several months. And that could be followed with the S&P 500 drop. Not expecting too sharp a drop because we are in that secular bull trend. Expect that 50-month moving average test right here, which by the time this happens later in the year, expect from 4,600 to climb towards the 48. So 48 is where I expect the pullback to come in S&P. I'm going to now end it with a couple of insights on emerging market. We wrote a blog about it over the weekend. EEM is the largest emerging market ETF by MSCI, iShares MSCI ETF. This is a beautiful cup, 45.4 to 40.61, back to 45.4. So that's roughly 5 if you add 4.8. 4.8 will take us from 40.61 to 45.42. So add the 4.8 to the 45.2, you're talking at a 50.23. That's the target. This is the beautiful pennant-shaped handle. Often you see a handle with a kind of a channel, but this is a nice pennant shape that it just broke out. Why did it break out? Friday, there was big news about a Chinese press conference coming up tomorrow on Monday, where the government wants to stimulate the private economy. They've talked to Alibaba CEO and all their EV maker CEOs and their internet companies, and President Xi has been kind of helping promote more of consumer. He's kind of diversifying out of U.S. dependency, knowing that exports might take a hit out of the tariff concerns, but he wants to promote internal consumption, wants to promote the Chinese economy and stimulate it. And through that, this was an expected press release or a press conference on Monday that got the gap up higher. If there is bullish news coming on that front, we can expect continued climb. When it breaks 45.4, I expect it to, over the next couple of months, climb quickly up towards the 50.23. So expect from the 44 to the 50.3, you're talking about roughly another $6 of 44 is about a little less than 15%. Expect that rally happening. We can see that the PPO is about to have a bullish cross above the zero center line. We can see that AD has hung in there, has begun to climb recently, and most important, relative to S&P 500, look at how this has behaved from early February. You know that we got the shakeout in the US stock market, the 10.5% correction since February 19th. What has the EEM ETF done relative to S&P 500? It has done nothing but climb higher highs. That is indication that emerging markets continue to outperform, and it will be beneficiary of money flowing in with the EM kind of climbing up towards the 50 level. So very bullish on the emerging market. As we know, a big part of this index composition is stocks in China. So Alibaba, Tencent are all parts of this. Of course, there are some Taiwanese like TSM is also in there, one of the top holdings. So those are all expected to do well and expect this to climb higher. One key, call it indicator of speculative money at the same time as a leading indicator where the market bottoms and starts moving higher, is Bitcoin. This is a beautiful move. So if you look at a long-term cup and handle, 69K was the peak in 2021, came to 15.5, back to 73.8. This is a beautiful cup. Then we can see a handle here. And over the months from February peak towards the August, September, we see a handle. And then the breakout in October into November. That breakout from a 15 to 73 measures closer towards the 132,000 level. So we got a wave one climb from 15.5 to 73.8. The wave two decline from there to test the 50-week moving average around 49.2 from 14. So that's from 15 to 73.8. You're looking at roughly 58,000 move, $58,000 move in the wave one. Wave two pullback from there to 49.2 and 49.2 to 109.3. That's a $60,000 climb. So about the same size of the wave one and the wave three, about 58 to 60,000. Then we got the pullback towards the low last week at 76. It was a lower low in price, testing the 50, climbing 50-week moving average beautifully, but we can expect the MACD to now, it is oversold, to start climbing higher, and so is the RSI. When it's in a bullish trend, RSI never dips back to the 30 level. It kind of hovers around the 45 and higher, and we can see it's at 47.5 and starts climbing again back towards the 70 level. So expect this. We also see this as a bullish candle with a nice long tail. That long tail means intra-week it turned higher. We are right now at 3.62% higher from this week to the last week. So we have roughly $2,900 or $3,000 move up in week over week. The bullish tail on the lower end of the candle. Expect Bitcoin signaling a market reversal. So what we saw on S&P with that climb that we saw on this 2.13% climb on Friday is just the beginning. We expect Bitcoin's weekly chart giving us a signal that there's more upside. Expect Bitcoin to break 109. So from here, from the 76 go to 109, it would likely form test of resistance there. From there, maybe another pullback towards the 89 to form a left shoulder, and then a potential breakout. So 76 to 109 would be roughly 33. At 33 to 109, that's 142,000. So we are expecting Bitcoin from anywhere from 135 to 142,000 is where upside breakout is. We'll see how it works out in the next few weeks, but this is signaling a nice bullish reversal, means the market is going to go higher. I want to end with a big caution on gold. People have been piling on to gold. People have been claiming that the world's going to come to an end. Crypto is a speculative asset. It's not going to have any footing as gold does, and people are extra perma bulls on gold. Be extremely cautious. Look at where the RSI is, deeply overbought at 80.91. Look at the pattern on this chart. This is a multi-year chart, right? You're looking all the way from 2007. So you see from 1923 down 2045 up to 2089, a beautiful, nice shallow cup. Then a handle, a parallel rectangle region it traded for several years from 2020 through 2024. Then it broke out. That measured target from 1045 to 2089 is 1044. At 1044 to 2089, 3133. It's a beautiful number. Where did we touch? We touched 3017, not too far. We closed above 3001. So 3001 to 3133, you're talking about another $132. That's it. Last week itself, we climbed $152. Last month so far. I mean, not last month, as in this current month. So far, we've climbed $152 for the month at 5%. Another 130 to that could happen in the next couple of weeks, but I would be extremely cautious. In this upcoming rally in the market, I expect gold to sell off, and I would expect Bitcoin taking over the money that people have been piling onto gold into Bitcoin as the better investment, as a hedge against the US dollar or against the world's concerns on the inflation and everything else. So I would be cautious on gold. That target of 31, 33, I'm watching very, very closely. I think once it gets there, I would lighten up on gold. Expect and guess where it could come down. It could come down. Parabolas never, this is a very parabolic climb. Parabolas never do very well when pullbacks come. They come back in a very sharp. Look at Palantir. Look at many of the parabolic climbs that have happened in the recent past and how fast they've come down. So I expect a very rapid coming down. And same thing with Bitcoin. Though you'd say Bitcoin is speculative, but this was a very parabolic climb, a sharp pullback. In a similar way, a sharp pullback to just test its rising 50-month moving average near 2472, 2500 would not be unexpected. I would be very, very surprised if this doesn't happen. I'm calling for a gold price around 2500 in the May timeframe. By the time S&P hits a higher high towards the 66, I wouldn't be surprised to see gold at 2,500. So be very cautious with gold. Summing it up, I would expect the market to have a nice rally setting up. Larry Williams is absolutely correct in his valuation model showing extremely oversold levels, very attractive valuation on the market, smart money accumulating while the market is coming down, bearish sentiment at an extreme, indicating that we are potentially setting up for a rally. Summation index, in my opinion, will start climbing towards 1100. And as the summation index climbs, the market breadth will improve. It will start climbing. Expect the S&P to be climbing back above to a higher high. The higher high, I would expect, potentially take us towards the 65, 60, 600 level. And from there, looking at the longer term chart of S&P, be cautious that this could then lead to a deeper correction, similar to what we saw in 2022. From 4,800, we had pulled back to the 3,500. So here from 6,600, I'd expect to pull back to the 4,800. So that's about an 1,800 point drop from 6,600 to 4,800. I would be very cautious and holding on to stocks beyond this peak, upcoming peak coming up. Emerging markets near term as a beneficiary. We expect this cup and handle breakout has already happened. Continued upside towards a 50 on the EEM, the MSCI ETF. And finally, Bitcoin's just got its beautiful wave 4 completion, retested that 78,000 level, tested its rising 50-week moving average, is now going to climb and likely make it to a higher high above 109,000, potentially towards a peak near 136 to 140. That said, Bitcoin, once it gets there, I wouldn't be surprised for it to get cut in half and pull back towards the 73, 74,000 level. So expect a climb up to 140s and then cut in half of Bitcoin towards that 73 is what I expect. Be very careful on gold. The high is not too far from the measured target. It's near 3,000. 31.33 is my measured target. Wouldn't be surprised to see a pullback from there towards the 2,500 level to test its rising 50-month moving average over the next couple of months. Good luck investing. Thank you.